Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we're going to be looking into technical analysis, the difference between leading and lagging indicators. When it comes to technical analysis, there are literally dozens of indicators which are available to traders. Choosing the right one for you will depend on your trading style and methodology. Most new traders will go through a process of trial and error when it comes to choosing the correct technical indicators for them. However, it is critical that you know how they work and how they can affect you trading. Technical indicators and tools fall into two brackets, leading and lagging indicators. Lagging indicators capture the movements of historic price action data and plots this information onto a chart screen. Traders decipher the patterns and use them to determine entry and exit points by assessing if the pair is overbought and likely to fall, or if it is oversold and likely to rise, or if it is indeed sideways trading. Example A is an example of a lagging indicator. The Moving Average Convergence Divergence, or MACD, takes the average move of historic price action over a set period of time and plots the information onto a chart. In this chart of the GBP-USD pair, with a 5-minute time frame, we can see that the price action of the pair is very similarly reflected in the MACD with its moving average, which both fluctuate around the zero axis. Traders use this imagery to back up their theory of future price action. In example B on the same pair and time frame is another lagging indicator, the Stochastic Oscillator. This plots historic price action data and tells a trader when a pair is entering into an overbought territory, such as above the 80 line, and when the pair may be oversold, such as below the 20 line. Again, traders use the data to help predict future reversals in price. In example C, again on the GBP-USD chart, is a simple moving average lagging indicator. This plots the average movement of the previous price action, where in this case a continuous line is formed onto the chart of the average of the previous 14 candlesticks, and we can see where price action falls underneath the moving average, it tends to trend lower, and it is also easy to identify on this chart that when price action moves above the moving average, a trend higher follows. Example D is price action itself on the same charts as defined by our Japanese candlesticks, where price action itself is a leading indicator. Leading indicators are the most widely used by professional traders to help anticipate future movements and help to define entry and exit points with much greater accuracy. When traders use price action in the form of candlesticks, they study the size, shape, and patterns of the candlesticks to predict future movements. Example E on the same chart is another leading indicator. These are support and resistance lines, which traders will draw onto the graphs themselves. From these lines, price tends to fall from resistance areas and rise from support areas. As you can see from this example, these lines will often alternate between being levels of support and levels of resistance due to price action retracement. Example F is another leading indicator. This is an example of a Forex broker's client's position table, which shows the net positions of how their trades are positioned on various currency pairs. Many brokers now offer this superb facility which will give traders added comfort when it comes to taking on trades, or act as a warning if the majority of traders on this position table are trading in the opposite direction. If you enjoyed the video, please like and subscribe, and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.